What's up everybody, Jaspreet Singh here, and while we might not officially be in a recession yet, the reality is the majority of Americans feel like they're in a recession. Now, when it comes to this whole recession stuff, you have kind of three different temperature points of people's opinions when it comes to the recession. On the cold side, you have entities like the government and the Federal Reserve Bank. About 1 week ago, or just less than a week ago, starting over last weekend, we first saw Treasury Secretary Janet Yellen come out, and that was the first time we started hearing about this changing definition of a recession, where she said that the traditional idea of a recession was 2 quarters of GDP decline. However, that's not a good gauge for our economy right now because our economy is strong, our labor market is strong, so we can't just look at 2 quarters of GDP decline and say that we're in a recession. Then a few days after that, President Biden came out and essentially echoed that sentiment, saying that our economy is strong, companies are hiring, everything is growing, so we are not in a recession. Even if we see 2 quarters of GDP contraction, that's not giving you a fair estimate. And then, of course, just a couple of days ago, Jerome Powell came out and said the same thing. He says that they're raising interest rates to fight inflation and that consumers are strong, but we are not in a recession right now, according to him. Although we might see a couple quarters of GDP decline, he said it's not a fair way to assess the economy, and he's saying that it's not fair to say that we're in a recession right now. So that's the cold side. Then in the middle, you have people who say that we are going to enter a mild recession. So this would be something like Bank of America. They've been saying pretty openly that they think it's possible that the United States could enter a, quote, mild recession in 2023. And this has been kind of the claim prior to this week, that if we do see a recession, it will be mild, it will be short, and it will be acute. This is what a lot of entities said. Even the Federal Reserve Bank said that too, that if we do see a recession, it will be that. That's why they keep talking about a soft landing, aka we won't really see much pain in the economy. And then we have kind of the hot side, where people are saying that we will see a recession, and this recession will be painful, and maybe the recession has already started. So these are entities like Deutsche Bank. Deutsche Bank came out, probably the first major bank to come out and say openly that they think that not only are we going to see a recession, but then they clarified that they believe that we're going to enter a major recession in 2023. And then you also have entities like Walmart and Target, which don't really say anything about a recession because they're not economists, they're businesses. But what they say is that they're already feeling the effects of a slowdown in the economy, and that they are predicting smaller profits into the future. Now, the one thing that you got to understand about that from a business perspective is typically when you see an economic slowdown, the places where people go to shop are Walmart. Because now when people are looking for discounts, you're going to discount stores, places like Walmart. So it's interesting that, inflation has hurt some of these retailers so much that even the discount stores, I know it's not a dollar store, but even the discount stores like Walmart are struggling keeping up because people just don't have the money to buy things. And what Walmart said was that although their revenues are higher, their margins are smaller because people are spending more money on groceries, which are low margin items, and they're spending less money on high margin items, things that actually make them money. Now, when I made my last couple videos talking about the second quarter GDP decline, and we made my video about the Federal Reserve Bank raising interest rates, you guys have made some hilarious comments about the changing definition of a recession. So I just wanted to talk and address a couple of them because we had one comment of someone saying, well, technically I'm 287 pounds, but does that mean that I'm not actually fat? And then someone said, oh, technically I'm 65 years old. Can I change the definition to mean I'm not old? So just kind of funny things that people throw out that I just kind of wanted to mention to lighten the mood a little bit. But now with all this going on, you might be wondering, why is the market rallying? Because I actually just read an article and it said that market rally is an unwelcomed development for the Federal Reserve Bank. And the reason why the market is rallying is because you have a lot of traders now thinking that the Federal Reserve Bank's fight on inflation is over, because now the recession is coming in. And inflation is going to be coming down, and so the Fed is no longer going to be fighting inflation. In fact, they're going to be doing the opposite. They're going to be stimulating, they're going to be doing quantitative easing, and they're going to be doing more inflation to pump up the markets. So in anticipation of that, people are very excited when they hear the idea of a recession coming, or they hear the idea of an economy slowing down, because now they're thinking, oh, if the economy is slowing, the Fed's going to have to stimulate the economy, which means they're going to pump money into the markets, which will help asset prices grow, So people are preeminently going out buying assets like stocks because they believe that a recession will lead to more Federal Reserve Bank buying of assets and pumping more money into the markets. And that could be true. The question is when, because when the Federal Reserve Bank spoke, he essentially, Jerome Powell, didn't give a clear answer, because this was a question that was asked to him 3 or 4 times, what is the breaking point? When are you going to change your stance and start inflating instead of deflating? And he never gave a clear answer, but he said that we're going to look at the data, and if we see inflation coming down, and if we see the economy slowing down, then we could switch courses. So think of it kind of like a teeter-totter, where on one hand here you have inflation, and the other hand here you have the economy. So if the economy is weighing more heavily in the Fed's books, then they might start inflating. But if inflation is weighing heavier, then they're going to continue with the deflating. They're going to continue raising interest rates. They're going to continue doing quantitative tightening. So this is where you want to pay attention to what the Federal Reserve Bank is doing, because we don't really know. And when it comes to the actual quantitative tightening, which means the Federal Reserve Bank selling off their balance sheet. So to put it in context, the Federal Reserve Bank printed trillions of dollars during the last couple of years, and they built up this balance sheet of around $9 trillion, meaning they had printed $9 trillion and lent this money to the government. Well, now in an effort to fight inflation, they are now starting to sell off some of these assets, things like treasury bonds. They're selling them out into the public markets to cool down inflation. Now, they haven't really done much yet, but what they're saying is by September, the selling off of assets is going to go into full force, and that's when we're going to see the Fed balance sheet really drop. So that's something that you want to pay attention to, because in theory, if you're putting more assets into the market, that increases supply, which could push asset prices lower. But then the question is, are they actually going to do it? Because if we push asset prices lower, that's more pressure on the Fed to stimulate at the same time. So you can kind of see that little fight going on, because you have all these traders saying that the Fed has no backbone, that they're not going to do it, which is why they're buying, while the Fed is saying that the economy is starting to slow down. So you can kind of see this little dynamic that's playing out here. And now the government has actually just proposed a new plan. It is called, I wrote this down because I don't want to get this wrong. It's called the Inflation Reduction Act of 2022, which is very interesting. Now, before I talk about this, I do want to let you know that if you want to stay up to date on what's happening in all of this economic stuff, from the Inflation Reduction Act of 2022 to the stock market to real estate to crypto, you have to check out Market Briefs. It is a completely free financial newsletter where every day our team is breaking down what's happening in the stock market, the real estate market, crypto, inflation, and the global economy. And guess what? It is completely free. It's fun to read, and it's easy to read. Even if you don't understand finances, I promise you're going to understand what's happening, and you're going to look forward to reading Market Briefs every morning because of how fun it is to read. So if you want to read Market Briefs, I'll put the link to how you can join for free down in the description below. And for those of you who haven't seen my last couple of videos, yes, I am in Manhattan right now. Times Square is that way. That way is Wall Street. So kind of right in the middle, right in Midtown. But let's talk about this Inflation Reduction Act of 2022, because interesting name with interesting plan. So the plan is to do a few different things. Let me just read it to you so I don't get it wrong. So one of the things that they want to do in this plan is they want to spend about $370 billion, just under $370 billion on climate change and clean energy. They want to reduce the government deficit by $300 billion. They want to do some Affordable Care Act subsidies. They want to reform the prescription drug market. They want to do some tax reform And along with that, they want to invest in some manufacturing here in the United States. So now you might hear this and say, how is this going to reduce inflation? Well, not everything is really meant to reduce inflation, but the main part that they're focusing on the inflationary side is the manufacturing investment and tax credits, where if you invest in building more plants to produce chips and other things for cars and technology, you do that here instead of overseas, that you will be incentivized to do that. And along with that, there's hundreds of billions of dollars of other spending. Now, let's talk about this from an inflationary standpoint, not from really the use standpoint, because there's two separate things. Like, I love the idea of green energy. I love the idea of taking care of the earth, but let's talk solely financial on the inflationary side, because if the name of this is the Inflation Reduction Act, we should really understand how does it work. So at first you got to understand inflation, right? Inflation comes from printing money and spending money without increasing the wealth. So when you print money, it reduces the value of the dollar, and that ultimately causes the price of things to go up. So the government doesn't have $400 billion laying around somewhere. So if they want to fund this, they need this money from somewhere. Because if the government had $400 billion, we wouldn't be $30 trillion in debt. We wouldn't have such a large national deficit. So how are they going to fund it? So this is where they do have a plan on how to fund it. And what they want to do is they want to impose a minimum tax on corporations, a 15% minimum tax on corporations. And then they want to enforce taxes better. So if you haven't been paying your taxes, they want to spend more money doing that, and they say that that will bring in about another $100 billion by enforcing more taxes. They want to end some tax loopholes, and then they want to do some drug reform, which will hopefully bring in some more revenue to the government. So what they're saying is, we're going to fund this bill by raising taxes here on businesses, raising taxes on wealthy people, and eliminating some loopholes. Now, the concern is, well, what happens if that doesn't work? Because the good news, we're going to be completely fair here. We're not going to be biased. The good news is they have showed that they want to fund this through increasing taxes, because there's three ways that the government can fund anything, and this is always true. You can fund something by raising taxes. You can fund something by cutting expenses, like by cutting welfare, cutting Social Security, or you can fund something by printing money. Somebody has to pay the price no matter what. And when you raise taxes, you know who's paying the price. Like if I raise your taxes to fund a new road, it's your taxes that are funding the road. If I am cutting your benefits to fund a road, well, now I'm taking away your benefits. I'm not spending money on you, so I have money to pay for the road. Very clear who pays for that. The third option, which is I spend the money and the Fed prints the money through inflation. Now, this is a dishonest way to fund an operation, and the person who pays the price is really everybody, the average person who is not financially educated, because now that's inflation. The Fed prints money, the government spends it, and then inflation happens. So starting off with the good, this program has shown who's going to fund it. But what happens if they're wrong? Because this happens quite a bit, where on one end, we have predicted how much this is going to cost. They're predicting just under $400 billion or so. But what happens if it costs more money? Because what we've seen happen time and time again is that the government isn't always the best when it comes to math. Maybe it costs more, maybe it costs double or triple, because that has happened on multiple occasions. Well, okay, so that's one side. Because if it costs more and they don't have enough revenue from the tax dollars coming in, then now you have a kind of a difference, a margin that has to be covered through money printing, which is actually inflationary. On the flip side, what happens if they don't generate enough tax dollars through their proposals? Because, I mean, if we think about this from the beginning of this video where I talked about the economy slowing down, because the economy is slowing down, if you're anticipating a certain amount of tax dollars from businesses, well, most likely they calculated these tax dollars from our last year returns, our 2021 returns. Well, 2021 was a boom year for business because there was so much money out there, so much money being printed, and businesses across the board, even if you didn't have a good product, were showing record revenues. People were showing record profits just because there was so much money and stimulus out there. So if you anticipate a certain amount of revenue based off of a boom year when we had printed the most amount of money possible, what happens then if the economy slows down? Because if we start to see a recession, if we start to see the economy slow down even more, that means the revenue that you would get would decrease even if you increase taxes, because now businesses are just making less money. And so if they're making less money, well, they're going to pay less money in taxes, and so the anticipated dollars could be less. So now if you bring in less dollars from where you think you'll make the money, well, now again, you're going to have to make up that extra cost through inflation. So just something that you to be aware about for the Inflation Reduction Act, because the concern is, are you creating more inflation to fight inflation? Are you fighting a house on fire by burning down the neighbor house? So, these are kind of the things that you want to pay attention to, because there's a lot of good things that we want to do. We want to do more infrastructure and manufacturing in the United States. It's great. We want to have clean energy. It's great. All these things are good. The question is now, how do we actually fund it? Because now, we can keep raising taxes, but we also need to cut spending. That way we can actually fund more of our operations. So, it's more of like a holistic picture. And the best example that I can give of this, because I know this video is getting a little bit long, I don't want to keep rambling, is when you go to the doctor for knee pain, and all they do is give you pain medication. But maybe the knee pain is coming from your back. Maybe the knee pain is coming from your lifestyle. Maybe the knee pain is coming from the way that you're sitting at work. And so if all you're doing is just taking pain medication, well, then maybe your hip is going to start hurting. Maybe something else is going to start hurting. So sometimes you have to take a step back and look at things a little bit more holistically. That way we can cure the problem, not just treat the symptoms. If you enjoyed this video and you want to see why we might be entering a once-in-a-lifetime opportunity to build wealth and what you can do to capitalize on it, I already made a video covering it, and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. When the 2020 pandemic happened, that was when the stock market and cryptocurrency was the biggest opportunity. Next time,